My first investment was a complete disaster. After reading The Intelligent Investor, I took some cash from my savings, downloaded the fintech app, and invested in index funds because everyone said they were one of the safest investments. Then I watched how time went by. When I finally checked the returns, I was surprised. I remember thinking, this cannot be what everyone is so excited about. Is there something I am doing wrongly? I honestly felt like maybe I should have been using the money to do something better. Looking back, I don't think the investment was the problem. Now me go be the real problem. Like many beginners, I was searching for things like best investments in Nigeria, highest investment with high interest, low risk investment, and where should I invest my money? I never stopped to ask the question that actually mattered. Will I need this money now? Will I need it soon? Where am I investing from? Is it in Nigeria or from the abroad? Which currency will I eventually spend this money? Am I trying to grow it for over 20 years? Or instead of leaving my cash idle in the savings account, do I simply need somewhere safe to keep my cash while it continues to earn me returns? And I can withdraw it anytime I want. Those questions completely change the answer for me. For example, if you earn and spend in dollars, buying a Naira investment without understanding currency risk could wipe out your earnings. If you constantly need cash for rent, school, business, or whatever, locking your money into the wrong investment can become more stressful than leaving it in your bank account. And if you're investing for a project you complete in Nigeria, choosing the wrong currency can quietly cost you money without you even realizing it. That's when I realized there are only investments that fit different goals. So in this documentary, we are going beyond your usual top 10 investment in Nigeria lists. We will break down Eurobonds, federal government of Nigeria bonds, Treasury Bills, commercial papers, and money market funds. We will explain which one actually works for you, how taxes and exchange rates affect your returns, where people unknowingly lose money, and how to choose the right investment based on your own financial goals and not what someone else told you. If you've ever wondered where to invest your money, which low-risk investments actually make sense, or whether you are making an expensive mistake without realizing it, then watch this video to the very end. Hit the subscribe button, like, share, and be a part of what we are building here. You're welcome. Let's look at how exchange rates affect Nigerian investment first. Before you meddle into any investment that offers high returns, I want you to learn from this example. You have $10,000 saved for investment in Nigeria. So you hear about an investment opportunity, maybe they are bonds, treasury bills, or any promising investments that pays 25% annual interest. So what do? You convert that money, your $10,000, you convert it maybe roughly into 50 million naira in Nigeria. So when you hear this on first glance, it looks very cool. Sounds like a good idea. But there are two versions to this story that many investors do not learn from or even consider before investing. Let me give you guys two scenarios. In the first scenario, let's assume that the Naira is stable or it has gained some appreciation with worthy value. Your 15 million Naira, if you put it in that investment that gives you 25% return, will become 18.75 million Naira. That is when we factor in the 25% annual interest. So when you convert the whole money into dollars, you end up with about, you can see that this is a very good yield. And it's not just because you only earned interest. You can also see you benefited from the exchange rate differences. But this is a perfect scenario. This is where everything is perfect and everything is shiny. And nothing about the market or economy is fluctuating. And the Naira, of course, still holds its value. Yeah. But when we look at the second version of the story, the second scenario, everything goes exactly the same way as in the first scenario. You take your money, the $10,000, you invest it, but the Naira loses about 30% of its value during the year. Here's the tricky part. As someone who investing, you are using a stronger currency to invest. This is what you should consider. Your investment still will grow at 18.75 million Naira if you are looking at it in just Naira. And of course, you still get your interest. But nothing changes until something happens. When you convert that your millions into dollars, you will notice that your investment has now been worth only $8,750. It means that you've lost over $1,250 or close to that on your investment. If you're looking at it from the Naira angle, it looks like you made some money. But you're forgetting that the Naira has actually lost some purchasing power in that period. Think about it. You made money in Naira, but you still lost money in dollars. That is why investing abroad requires a lot of skill and strategy. It's not just about finding whatever opportunity gives you the highest return or the highest interest rates. You have to deeply understand the currency risk, market conditions that are shaping things, economics, and even geopolitics of the market you are investing in, because anything happening shapes how the world sees value in these places, which will in turn affect your investments and expected returns. So once you understand this, it becomes very easier to approach investing strategically. So you will not be looking at it more of like from sentiment or gambling. Quick question, guys. Before today, did you think a 25% investment could still lose money? Something that was giving you 25% return on investment? Tell me in the comment section. I'm very curious. Now let's look at the 4 main fixed income investments. Now that we have addressed the biggest misconception about investment, let's look at the actual investment options. Each one you see here solves a different problem. Each comes with its own downsides or trade-offs, which you must consider, and even those that are taxed, some are taxed and some are not taxed. Let's start with one of the safest options for Nigerians abroad: Eurobonds. Diaspora investors actively looking for dollar-denominated assets to protect their funds against inflation or the naira fluctuation value. So they tend to prefer Eurobond because it protects or it hedges against inflation. But despite that name, these assets, it doesn't mean they're actually limited to Europe. They are simply bonds issued in foreign currencies. When I mean bonds, they're just basically government borrowing your money, promising to pay back at certain interest rate. So you are basically borrowing government your money. And Eurobonds are usually in US dollars. So that's why many diaspora investors tend to consider it. Your investment stays in dollars, interest is paid in dollars, and your principal is still returned in dollars. That is the main money you actually added. That is the real capital. Still stays in dollars. So if the naira crashes, your investment does not crash with it. Let me give you guys a clearer scenario. If you invest that same $10,000 in Eurobond, paying around 8%, you'll receive about $800 interest over the year. Everything happens in dollars. There's an advantage if your investments or your future expenses are also in dollars. Meaning, if you're somebody whose transactions are mainly in dollars, of course, you're going to see that there are lots of goodies. But there's another caution that many people don't like seeing, which is that Euro bonds are also not risk-free. Nothing comes free. If, for example, the global interest rate rises or Nigeria's credit rating worsens, the market value your bond holds will fall. If you are forced to sell before maturity, before the thing could actually gain a lot of value, you will still lose. You might actually expect less than your expectations. So, while Euro bonds remove currency risk, they still carry market risk. Now, the tax situation when it comes to Euro bond is a bit straightforward. Because you are investing and earning in foreign currency and not in local naira accounts, you generally avoid the automatic withheld taxes that apply to some domestic investments in Nigeria. If you live in countries like the UK or Canada, where Nigeria has a double taxation agreement, your tax obligations may actually even be reduced further for you. Let me give you guys a breakdown. I did my research. So there are some treaties that ensure that you do not get taxed twice on the same income by two different countries. And it's actually very relevant if you're investing back home in Nigeria from abroad. There's something called the UK Treaty, The UK-Nigerian double taxation agreement has been active since 1988. It prevents the UK government and the Nigerian government from taxing the same investment returns. So you can see that. So if you have something back home here, don't expect it to still get taxed when you pull it out back in Nigeria, over there in your country. The Canada Treaty, the Canada-Nigerian double taxation agreement has been fully enforced since the year 2000. It governs how investment profits, dividends, and interest are handled between two countries. So basically what I say here is the exact treatment depends on your country of residence. This is why you should actually do your research as well, which is why I think it's very important you either speak to a tax advisor or you really do your research to know if it's even worth investing in, because it doesn't make sense if you invest in something, gives you high returns, and see that if it's taxed in Nigeria, it also gets taxed in your home country, in your resident country. It basically discourages or betrays the whole idea of investing in the first place. So the next one here is the federal government of Nigeria bonds. These are long-term loans you give to the government. It's best for investors who are looking for tax-free kind of investments that are backed by government. Now let me show you guys where this becomes interesting. If you are building a house, developing real estate, funding a business like I said earlier, or you are paying for major projects inside Nigeria, the federal government of Nigeria bonds, FGN bonds, can actually make a lot of sense for you. I said earlier, if you're earning in the same currency you eventually spend inside the system, it makes sense to invest in that currency. You get it? That means exchange rate fluctuations won't bother you that much. But if your plan is to bring those returns back abroad, you see that's where the story changes for you. This is because a weaker naira means weaker purchasing power once you convert everything back into dollars, pounds, or euros. So always match your investment currency with where you intend to actually spend the money, especially when the goal is to actually move that earning within Nigeria as a diaspora. So some of you that you stay in Canada, you think there are some investment projects you really want to pursue in Nigeria here, and most of the transactions will happen in Naira. It doesn't make sense that you gain all the yields from the investment, convert it and still take it back to Canadian dollar. That does not make sense. It's best that you leave it there, use the money to pursue whatever you want to use there, because it's in Naira. And the Naira dancing up and down will not affect you when you move it back to your currency. So it's best to leave it within that place when it's what you're using it for. So here's another advantage many people don't know about this. Under the Nigerian Tax Act, the interest earned on federal government of Nigeria bonds, like I said earlier, is completely tax-free. So if your bond generates, for example, 1 million naira in interest, you will keep that 1 million naira without worrying about the government's taxing it. And there's just another important exception. If you are somebody anyway who is actively buying and selling bonds for short term, maybe you're a broker in the second markets, those capital gains you gain, they're taxable. Like I said, it applies to the brokers or anyone who is trading all these instruments as a regular business. So in the next section, we'll cover Treasury Bills, commercial papers, money market funds. What actually determines their prices, how to choose between traditional banks and fintech apps that you want to use to, run these investments in Nigeria. From here, the documentary will shift from understanding investment to choosing the right platform and protecting your money. Treasury bills versus commercial papers in Nigeria. We're going to analyze their yields, their risks, and their taxes. Now, let's look at Treasury bills, or what they call T-bills. They are short-term loans you give to the federal government. They usually last around anywhere between 91 days or 1 year. Some have seen some that even 60 days or so. So the commercial papers, on the other hand, work in a very similar way. But the difference is just that you are lending your money instead to the government, you are lending it to reputable companies instead of the government. You can actually take a look at both of them as the short-term versions of the long-term bonds we discussed earlier. People love them because they are very simple, and most times they bring attractive returns, and they also carry very low risk. And the very best part of the whole thing is they do not lock your money for decades. They are super useful if you want to keep your money somewhere in a safe place, but you also want it to keep working for you and generating returns instead of lying down idle in a savings bank account. But there's something many people completely overlook. Because they are short-term investments, timing is very important. It does not also mean that they are immune to all this fluctuation, currency risk, and even inflation. Let me give you guys a clear scenario. Let's say your treasury bill matures next month, and before you are able to cash out, the naira experiences another sharp devaluation. You can see you are still going to earn your interest in naira, but the moment you convert that money into dollars, pounds, or euros, much of that gain can simply just disappear. That's why short-term investment doesn't automatically eliminate the currency risk that comes with the investment. It just shortens the window. You are not exposed to it as much as people who leave it for a very long time in bonds. It would have wiped away most of their value. It just shortens how long your money stays in investment, especially when the currency is fluctuating. So you may be able to pull out your funds faster than someone who's locked in their money in longer duration assets like bonds. Let's look at taxes and how they affect T-bills. Now, unlike Federal Government of Nigeria bonds, FGN bonds, Treasury bills does not get tax exemption. They are taxed. 10% withholding tax is automatically deducted from your interest before the money even hits your bank account. But the good news, diaspora investors, many of them, that's where it ends. You don't have to go through another extra paperwork filing tax issues in Nigeria for that income you earn from your T-bills. Everything is sorted because the people you are investing with have already taken out this tax. And here's another thing that is worth checking. If you live in a country that has a double taxation agreement like Canada or the UK, that withholding tax can actually drop from 10% to 7.5% for you. So it's not automatic for everybody. That's why you have to do your research. Know your country. Does it have a double taxation treaty with Nigeria? Let me ask you guys a quick question. If you had to choose today, would you rather lock your money into maybe bonds, which offers long-term yields, but it take time, you stay there for a long time, or you keep things very short with short-term investments like T-bills? Drop your answer in the comment section. I want to know what you guys think. The fourth option here is money market funds. Let's look at the best money market funds in Nigeria for emergency funds and cash flexibility. It is best for investors who need flexible, low-risk places to put their cash for short term instead of leaving it idle in the bank. It's best for people who need their cash accessible. You want your cash now, but you still want it to be working for you. You don't want it to stay too long. And I noticed that all these money market funds, they become very popular, especially among young investors and very busy professionals. Let me show you guys how it works. So instead of buying single investments yourself, your money joins thousands of other investors inside a professionally managed fund. They pull it together and the fund manager takes it. Then they put that capital they used to buy safe and short-term instruments like treasury bills, commercial papers, and bank deposits. So the biggest advantage is the flexibility it brings. Many money market funds actually allow you to withdraw your cash within 24 to 48 hours. You see, the period is shorter than even T-bills. Your money is not trapped for years or even months. Within days, you can actually pull it out. I think that's why many people actually prefer money market funds as an emergency cushion or a safe holding spot for their cash, especially when it comes to investment. But another thing you must understand is that flexibility comes with one clear downside. The interest rates or the returns are not fixed. Today, a fund might, yield you 18%, but a few months later, that yield can just, don't see them as high guarantee, high yield investment tools. No, just see them as short-term things that you need. Instead of leaving your money in personal savings account, you just use this to, get your money working. Then you pull it out whenever you need it. Let's look at how the government treats it in terms of tax. The tax setup here is just the same thing with treasury bills. Any interest or dividend payout, they are still subject to 10% withholding tax before it even reaches you. They've pulled out the 10% tax. And once that is deducted, you are typically considered fully compliant from a Nigerian tax perspective. So let me ask you guys. So which fixed income investment is right for you? At this point, you can already see the bigger picture. You can see that there is no single best investment out there. They all have their upsides and their downsides. They are simply different tools built for different financial goals. If your future expenses are going to be in overseas and you want to avoid local devaluation, Eurobonds will help you eliminate the currency risk. If you're actively building wealth inside Nigeria to fund most of your personal or your business projects, of course, you can look at FGN Bonds. They become far attractive because you're earning in the exact currency you want to spend in. And if you need quick cash, You can look at Treasury Bills, money market funds. Those will just basically fit your needs. So is there a right choice? Well, you want to consider the highest interest rate when making your decisions, but not just that. Also know when you intend to use the yields from these investments. That's one more important. Remember I said earlier that some investments are better done in Nigeria if you intend using their proceeds, but if you are moving them back overseas, you want to be strategic. Many people prefer Eurobonds. Many people abroad prefer Eurobonds because they know their proceeds will be abroad. That strategic part most financial conversations tend to ignore. If you know most of your transactions will be in Nigeria, probably because you're funding something in Nigeria and you know you will spend money in Nigeria, let the investment focus on things like the T-bills, the money market funds, the FGN bonds. You see it. But if you know that hey, most of my transactions are going to be in the other currencies like the dollars, the pounds, move your focus towards the Eurobonds.